This podcast is a continuation from last week. Mom and Dad are still in Florida, and we didn't have enough time to talk about everything we wanted to talk about last week in one episode. So we are back with another episode.
In this episode, we are talking about infinite banking policies. What kind of life insurance do you need for the infinite banking concept? And how to tell the difference between a good policy and a bad policy.
I have a bad policy that was just sent in for review recently, and we know it's bad because the guaranteed values never exceed the premiums paid. Now, you kind of expect that if you're dealing with term insurance. You never expect it to build a cash value, but if you're buying permanent insurance, you probably want to have more in it at some point than what you've paid in premiums.
You definitely want to have more in it.
I have the illustration here, and you'll see that the guaranteed values go to zero 42 years after this policy is started. I'll be on page 3. That's when this guy is 84.
And the year before that's not much better.
What is it?
Your total cash value is $285 the year before. And you've put what into this policy at this point?
220,000.
Over 220,000.
Yeah. 220,800
I think it's about year 23 that the cash value starts going down, and it never got up.
I got a deal for you. I got a deal for you.
Is that a minus?
You pay me $220,800, and I will promise to give you $285 if you want it.
Over what time frame are we talking?
We could do 42 years.
Is that minus 99% return?
Is it worse than that?
I don't know. It's
pretty
bad.
close. Oh, that's bad.
Bad.
Are we going to get in trouble if we say who this is?
Yeah.
Okay. Yeah. I won't say who the policy is, but it's called...
Kind of want to.
Their product is called Signature Performance IUL. Would you hate to see what any of their other performance products are?
I'm never going to buy that product on guarantees, and I don't know anybody that would. They're all buying it off the projected values because the projected values look like they're going to do something. But if I'm going to buy insurance, I want to have a guarantee of some sort. Otherwise, I'm just speculating. It's just another investment.
Why would you buy insurance if you don't get a guarantee?
I don't know, but people do. But I don't think it's because they're looking at the guarantees. I think it's because they're looking at the investment aspect.
Can you imagine buying fire insurance like that?
No.
Like, if there's a really bad fire, we'll build you a mansion back unless we decide not to, and then we'll rent you one of those little tough sheds from Lowe's or whatever, and we'll put it up, maybe do some chain link around, maybe.
Yeah. So instead of your home, let's say you have a 3,000 square foot home, we'll get you a 300 square foot tough shed.
Maybe a carport too.
Nothing against tough shed, by the way.
It's important to get a good policy. If you're going to get your insurance, get your guarantees as guaranteed as possible. You should be able to have a guarantee that you will have more in cash value at some point than everything that you've paid in premiums. That's reasonable when you're buying permanent life insurance.
And fairly early on, how many years would you expect to see that?
I would expect to see it within 15 years.
Yeah. In some cases, maybe even 12.
On a good policy.
Yeah, with good health,
Yeah.
Younger.
It might take a little bit longer if somebody's older or in poor health.
Sure.
You have those factors to consider. But
sure, but
you can see that by looking at an illustration. You should know what the guaranteed values are before you purchase the product.
Absolutely.
And then if you want the investment aspect, go ahead and balance that with something else in your portfolio. Just make it in a separate bucket. Don't try to mix the two together. Otherwise, you lose your guarantees.
So this particular one that you brought here, it's an IUL policy.
Yes.
Which stands for Indexed Universal Life. The universal life...
It's not an investment because they're not actually investing it in the market.
Right.
The insurance company is trading options on an index to give returns like it is.
The universal life family of products, if we can call that, they're classified as permanent insurance. They're not very permanent if you look at the guaranteed values because they always, go to zero in the guaranteed values. But the hope is that interest rates or, investments are going to do well enough that the cash account will get credited with enough interest to offset the increasing cost of insurance as somebody gets older. And it will actually outpace that, and you'll have some extra money besides. We never see them turn out very good. Universal Life gets credited with an index or with an interest rate, and that interest rate just isn't all that good. It was okay in the 80s. Maybe some of those policies would have lasted if those interest rates had continued. The variable universal life, it's not as popular now as it once was, but that is a true investment.
It is. You have to have a securities license to sell it.
Those didn't do too well either. So index universal life is the new kid on the block, has been for some time now. It's not actually invested like variable universal life was, but it mirrors an index. And that's still the basic premise, is that the index will do well enough that they can credit enough extra to the cash account that it will take care of the increasing cost of insurance premiums, and you'll have extra besides. But as we can see in the guaranteed values in this policy, it's not guaranteed to do that. In fact, if you don't do pretty well in the index side of things, then you are going to end up losing your policy.
They put things on these index universal life policies. If the index does really well, you're not going to get all that growth, though, because they put a cap on it. And if the index does really poorly, in exchange, they're saying, oh, well, you won't lose money. You won't go below zero. But you still have the policy fees and the cost of insurance coming out of that bucket, that cash bucket. So it's not like the cash value can't go down. We see that it can go down on those guaranteed values.
Now let's move from universal life policies, which we were just discussing, to the whole life insurance policies. Not all whole life insurance policies are created equal.
No.
Some of them can work very well for the infinite banking concept, and some of them will not, do not, and shouldn't be sold as infinite banking policies. We see people that have whole life insurance policies that aren't optimal, but based on where they're at in the length of time they've had the contract, it's worth it to keep it. We see other whole life insurance policies that they haven't been enforced as long, or sometimes they have been, but we can still do a 1035 exchange, which is like a 1031 real estate exchange. Move the cost basis out of that whole life insurance policy into a better policy that's going to have better guaranteed growth for them, and that works. What do you think? Is there a huge difference in getting the right whole life insurance policy or just any whole life insurance policy?
If you want to use the policy for infinite banking, there is a huge difference in the way a policy is designed. That's going to make it worthwhile for infinite banking or not as worthwhile.
A well-designed policy builds cash value quite quickly. And that's important when you're using the infinite banking concept, because oftentimes you're using the cash value of your policy to finance purchases in your life. So if that cash value never comes up, you never have the opportunity to use it like you could otherwise.
Nelson Nash said, when you're designing a policy for the infinite banking, you want to pay as much in premium for as little death benefit as possible at the outset. That builds the cash value element up, and it actually helps to build the death benefit up later in life when you're more likely to die anyway. So you get to solve both by doing it that way.
It's a different method than what life insurance is generally sold.
Yes.
They usually say, okay, come up with a number you want in death benefit, and then how little can you pay to get to that number? In this case, we're saying, okay, how much can you afford to put into life insurance? We'll convert as much of that as we can into available cash value and get as much death benefit as required by, the IRS not to be taxable.
Mm-hmm.
And then what we do at McPhee Insurance is we say, is that enough death benefit for somebody's needs? And if it's not enough death benefit for you, then we supplement with the convertible term policy, which is very inexpensive, so it's not going to increase your cash flow outlay, but it is going to increase your death benefit.
It's very inexpensive at the outset. Most people don't keep it beyond the level term period, which is why we're using the whole life.
But we also make it convertible because
–
sometimes a health situation will arise, or somebody's getting older and you don't know what's coming up. If they decide, I'd like to keep this death benefit around, or, hey, I'm ready for another infinite banking policy, they can just pay the premium to convert it, and they don't have to go through the underwriting process again. So it's kind of doing three things. It's solving their need for cash, it's solving their need for death benefit, and it's ensuring their ability to get more insurance when they want it.
We had that doctor in California, and he bought term insurance, convertible term insurance through us. And then it wasn't even something that happened with himself. It was someone in his family got some disease that I guess can be passed down to the
genetic.
Genes. Genetic.
Genetic related.
And all of a sudden, his rating level went from good to
really bad,
very poor. And so he just converted some of that term.
Instead of buying the new policy. Which is, when you convert term, it is a new policy. but you don't have to go through the underwriting standards. You already have the death benefits, so they say, yeah, you can just keep it. And you pay the premium to make that permanent instead of temporary.
Getting high cash value into a policy for infinite banking, that's usually called a paid up rider or a paid up additions rider that we add onto the policy to make that happen for people. Nelson talks about in his book, Nelson Nash, how adding that rider is sometimes called overfunding a policy. It's not that, okay, but it's an example of misclassification, kind of like when Christopher Columbus sailed west to get to the east. He was trying to go to India. When he arrived in the Caribbean, his guys saw the Indians. Of course, they weren't Indians, but they called them that, and the name stuck. And there's examples of misclassification like that all over the place. So when people talk about overfunding a life insurance policy, they're talking about adding this paid up additions rider. It's a misclassification because it's not really overfunding the policy.
Right.
But a policy like that minimizes the death benefit, maximizes the cash value. It gives a place for people to use that value. Now, some agents will take this to the extreme, and they'll say getting a little bit more cash value in this product is wonderful. We're going to try to get a lot more cash value. And the way we're going to do that without violating the limit that the IRS has set is we're going to add more term insurance to this policy. So now they artificially boost the death benefit up, which violates Nelson Nash's rule that says you minimize the death benefit. Then they can try to dump a whole bunch more cash in through the paid up additions rider. These policies are sometimes called 90-10 policies.
You have a video on 90-10 policies you did that I thought was really good. It's on McPhee Insurance. And if you go to the McPhee Insurance YouTube channel and you just search for 90-10, it'll come up.
When the video starts out with a grown man playing with Play-Doh, you know it's going to be good.
Yeah, you had Play-Doh in that video.
That was
It was a great video.
It was good, though. It was good. That video is getting a lot of views, so I think it's helping a lot of people that are wondering about the 90-10.
It's really not hard to design a good policy.
No, it's not, but there are some challenges to it. I think the first challenge is you just don't know what you don't know. When you go through insurance training, they don't teach you how to make a high cash value policy.
No.
The insurance companies don't teach you how to make a high cash value policy.
Not really. If you get the right person at the insurance company and you ask the right question, they probably would. Not all people at the insurance company would know how to do it. So that's the caveat for the right person. And you have to ask the right question. And then you have to know, what parts are pertinent and what aren't to be able to do it. So that would be one thing that could make it hard for somebody to design a policy. I remember when Dad read the Infinite Banking book, he thought he needed to go find somebody.
An insurance company.
Yeah, an insurance company and tell them, this is how I want my policy designed and try and follow the stipulations in Nelson's books. Thankfully, he was able to find somebody who knew how to do it back then and get a policy from them. So that worked out good. And then, the last 17 years, we've asked a lot of questions. We've done a lot of research, especially in like that first year, first two, first three. We were learning a lot about different types of insurance policies, how they're designed and stuff. So it feels like second nature to us. It's not hard at all.
Yeah.
I could go run an illustration in less than 5 minutes that was a great policy.
There's a lot that has gone into that process.
Yeah.
Some of the executives at the insurance companies tell us that we know more about their products than some of their own people do.
I believe that because we've talked to some of their own people.
Every company, too, because we represent multiple companies, they'll all have different inside terminology for what it is. Like, here's a PUA. Well, we don't have a PUA. Names. We have an FPUAR.
Yeah.
Like, what's that? Well, it's the same thing. It does the same function. It's just a different name because it's a different company.
And then the one company had a PUI.
Did it really?
Yeah, paid up insurance.
Okay.
PUIR for paid up insurance.
There's another company that has a name that sounds nothing like paid up additions. I can't remember what it is right now, but it's like this long 5 or 6 letter abbreviation. You wouldn't know what it is unless you recognize it for what it is.
I need to learn that. I kind of like collecting though. My personal best is FPUAR, flexible paid up additions writer.
So I think just the knowledge element could stand in the way of designing a good policy.
Yeah.
No, it's not hard, but you've got to know what you need to know.
And finding the information then if you do want to do the right thing,
And also the right company, because different companies, the products are not.
And then probably the last thing would be, it could be hard to design a good policy for infinite banking if you just have trouble doing what's right. because there's financial incentive not to make it as good.
Can you explain that? for
You
me?
don't get paid commission as much when you put more towards the PUAR or the the
FPUAR.
FPUAR or the PUI or the PUA rider, whatever it is. You don't get paid as much commission when you're assigning premium dollars to get paid up insurance on a policy. You get paid more when you are funding the base policy more heavily. And to be able to have a good policy for available cash value and the infinite banking concept, you actually have to write the policy with less base insurance than paid up insurance. So maybe you're like 40% base and 60% paid up insurance to get a really good infinite banking policy.
That cuts commissions by about 40%.
Yeah.
Or by about 60% to get to the 40%.
Is there any companies that are paying on the paid up insurance?
I think there are
They pay a
companies
little
that
bit.
pay a little bit.
So they pay a very small percentage of the amount that's going to paid up insurance, if any, but they pay more commissions per dollar amount spent on the base insurance coverage. Well, if you're automatically cutting that in less than half, that's decreasing the commission quite a bit. And so if a client comes to somebody who wants an infinite banking policy and the client, that is, doesn't know specifically what to look for, the insurance agent could tell them anything they want and say, oh, no, we have to be 50-50 or we have to be 80% base, 20% paid up insurance. Or they just do it that way to increase their commission and the client has no idea.
It's time for an ad break.
Really? Already?
We'll be back after this to talk about our personal policies. Let's see what the ad break is about today.
Do you have a life insurance policy, or are you thinking about purchasing a life insurance policy for the infinite banking concept? At McPhee Insurance, we specialize in designing participating whole life insurance policies that work with the infinite banking concept. But we also review policies. So if you have an existing whole life policy, or you're thinking about purchasing a policy from another agent, we can review that. We review hundreds of policies. It is well worth the $75 for an independent look at that policy so that you can have the peace of mind that it's going to work exactly like you want it to for the infinite banking concept.
We get quite a few policies that come in for review because that's a service we offer, like you just saw in the ad. Sadly, most of the policies we review are bad policies. That's also good news in a strange way, because the sooner somebody knows they have a bad policy, the sooner they can go about remedying that situation and getting the policy they really wanted to begin with.
I have a great example of that. It's sitting right here on the table. This is my chainsaw. It's a Husqvarna 372 XP. This is a legend. Yeah, it's sharp.
Sharp.
This is a legendary saw. So when I found one on the used marketplace, I was very excited. I went and bought it the very next day. And we used this saw. I was happy with it, but then we noticed it had an issue when it got hot.
Yeah, hot starts were not very...
Can't start
easy.
hot. So I did a few things to it trying to fix it.
You did the ignition coil, which helped.
I did the ignition coil, yeah. That would give you all the symptoms of a bad start.
Right.
But then that didn't fix it. So I was like, something else has got to be wrong. So I found out that this saw has a bad piston. Bummer. Okay, not the end of the world. I'll order a new piston. I'll put it in.
Sure.
I'll get it fixed. Then I took the cylinder off. It's not a good saw. The amount I would have to pour back into this saw to fix it isn't worth it financially. I would just go buy a new saw.
Like a bad
What was
policy.
wrong with it? I mean, why couldn't you just replace the piston?
The piston right here on the skirt, it's cracked. That's all gone. That shouldn't be like that. All that metal went down into the bottom of the engine. Some of it went up to the muffler. I'd have to split the case on this, redo the bottom seals, redo the rod might still be good, but I need a new piston, new rings, and even a new cylinder because it damaged the cylinder wall. By the time you add up all that together and you're still running a used platform, your oiler is probably going to go out. Other things you're going to constantly need messing now. Just buy a new saw.
That's kind of like a bad policy versus a good policy.
It is.
You get a bad policy, and as soon as you knew it was bad, once you saw the scoring on the cylinder walls and the missing portion of the piston, as soon as you knew it was bad, it basically gave you the freedom to go get the saw you thought you were getting.
Yeah.
Now, you picked this up at a good deal. It was probably worth the risk, but you also learned some stuff so you won't have to make that, repeat that process again.
This is my first chainsaw I've ever owned, so I didn't know anything about buying a used saw. There's some things you really got to look out for. This is the easiest, simplest trick, and it really would have saved me if I would just have looked for it, but I didn't even know
What to look for.
how to look for it. I mean,
That's the situation, a lot of the people getting the reviews are in. They know they should know something more, but they don't know what it is. And I don't really blame them. That's not their, their business, their profession, like it is ours to know all these things. But once you know or have somebody that can show you, it makes a big difference. You can look for them yourself, or you can know what you need to be asking or looking for, and it helps.
so with this saw,
So you're just pulling off the muffler right now.
yeah, when you get the muffler off, so what I found when I went to replace the piston, I pulled the cylinder off, which is quite a procedure. And if you go to buy a used saw, they probably don't want you stripping it all down, pulling the cylinder off.
Right.
But there's a really easy way you can check it. You just pull the muffler off and you look. I think I've got one more bolt here.
That way you can look into the cylinder.
Yeah, and you can see the piston in there. Now you can't see the piston skirts cracked. I only found out once I tore the cylinder off, but I could see signs. Rings are frozen, scoring down the piston. I did drain the oil and gas out of the saw before I brought it in here.
So, Mom, if you're watching this episode, he got the oil and the gas out.
Maybe I'm glad she isn't here today. Maybe stay in Florida till we're done recording this.
We'll give time for the smell to get out of the office.
Okay, here we come. Alrighty. Have a look in here, boys.
Oh, there we are.
Oh, you got a light too. John,
nice.
can you
So you can
pull
see
the
the edge
recoil?
of the piston.
So as you pull
And now
that
if you
slowly,
cycle that, you can see and
Yeah.
if you pull that,
See, those rings are
those
frozen.
rings are just absolutely embedded.
so you can't really do this right here, but when you take the cylinder off, I can pick those with a screwdriver, those rings. They will not come out of there. They'll break.
They're basically fused to that piston.
Yeah, they are.
You want to pull that? Yeah, right there.
There.
Oh, pull it all the way down.
It's just like one piece of metal.
Yeah.
You can see it's two, but
Can you pull the piston down? I want to see the cylinder wall on the other side.
It's a little tough to see. If you take the spark plug out and look through the top, you can see the top of the cylinder, and it is all covered in carbon.
Oh, look at that. I can see tons of carbon up there at the top of the cylinder.
Yeah. So that was pretty disappointing to find. But it was also kind of nice because you have this frustrating problem, and how do I fix it? It always dies right when you need the tree to come down or right when you're cutting your bull blank. And I tried fixing it, and then I pull it off, and I'm like, piston. Then I get the cylinder off, and I'm like, it's a new saw.
Yeah.
And
So
it kind of hurts because I spent a lot of time and I spent some money doing it. But, it's a learning lesson, and I'll know what to look for in a used saw next time.
we're suspecting that maybe the fellow who had this ran this without oil in the gas, because if you know about two-stroke, it gets its lubrication from the fuel, and you have to mix the oil in with the fuel. If you don't do that, then it won't lubricate the cylinder, the piston, and the rings correctly, and you'll get problems like this. You don't know how used equipment has been treated prior to get it, but now Steven knows this trick. It's a lot like reviewing a life insurance policy. You just have to know what to look for and what to do. If you can pull this muffler off real quick and look in there, it could give you a clue as to whether it's a saw worth dropping some money on or not.
That was a relatively quick process to pull off that muffler.
Yeah.
Yeah.
And the silver lining on this one is these 372s are beasts. There's probably going to be a point in our life where we pick up another one used somewhere, and Steven's keeping this as a part saw. There's a lot of parts on here that are still good, and they'll transfer over to another 372, no problem. And so we probably have a nice 372 in the future that'll wear some of these parts, and it's not a total loss.
No, it's not a total loss. Got plastics and,
You want to get your new...
I do. Have
Your
you seen
new
my new
beast
saw?
stuff?
I've not.
Okay, I got to show you. Here's the new boy.
Ooh,
That's a
pretty.
long bar on that thing.
It is. It's a 28-inch sheath because I have a 28-inch bar for it, but this is just a 24 on it.
Now you can use the bars off and bars off this other saw on this one. So
Yes, I can.
We're already
Yep.
swapping parts a little bit. This is a newer model of the same saw.
This is the 572, and I didn't mess around with buying used. When I bought this, I was tired of it not working, so I went right to the dealer and I bought this. If I do have a problem, I bought it through the dealer, so it's got the warranty on it. I know it's gonna. If it doesn't work right, they'll make it right.
What a beauty.
There can be value working with a warranty like that, or working with an agent that understands how the life insurance policy works and what to
That's a good point.
what to fix in the process of getting that policy if something goes wrong.
And when you're buying new equipment too, you also want to look at what kind of service is available for the equipment, because if you're left with it hanging without service with your new piece of equipment, that's no bueno.
No.
And that's pretty common in the life insurance agents or industry, actually, is once you sell a client a policy, the client pretty much never hears from their agent again. In a lot of cases, not all cases, but a lot of cases. And that's one of the things we've done different from day one at McPhee Insurance is when we sell a life insurance policy, we see that as the beginning of the relationship. We're going to be available to help change addresses as people move, change beneficiary names when people get married, be there to, help, the survivor process a death benefit, make sure that happens. We've done several of those over the years, over the 17 years, as you can imagine.
And even just talking to new clients, I was talking to a couple earlier this week. I had met with them a number of times as they were learning about the process. And then when they were ready to move forward, they thanked me for explaining everything patiently and with so much transparency. It turned out they had been shopping around with a lot of different agents, and they told me they kept coming back to us because of the experience they had here. And that's wonderful to be able to
I feel like they say that too because you're very detailed on making sure you understand how each piece works. So if somebody asks you about the piece, you understand how it works, you just share that information. A lot of times, it seems like especially in life insurance industry, people have these pre-prepared sales presentations or scripts that they say. So that if they hear a question that even resembles a sales pitch they have ready, they just roll the sales pitch. And it doesn't really help, and maybe they don't know the answer. Maybe they don't know the answer.
I think some of them don't, to be fair.
They're like rolling to their lines like,
This
this product is a great product. It sounds like something came straight from the insurance company brochure.
This saw is a beauty, but it's also heavy. I'm going to set it down.
Okay.
You got a little bit of use out of that one because we cut down several trees with it, actually.
Yeah, we did. And we cut down that tree at Jesse's that was kind of near the roof.
Yeah, that one. We cut down that dangerous split tree. You have footage of that one.
Yeah, we do.
You want to put some in here?
I'll throw some footage in for you guys.
And then we cut down that dead tree and then some limbs over. Yeah, so this saw it did some work, but it's not a great saw because of some of the problems.
It's not dependable. Yeah.
So now we know about your chainsaws, Stephen. Let's hear about your policies. And what is your strategy with the infinite banking concept and acquiring life insurance policies? How do you think about that? What have you done in that respect? You're in your early 20s right now, so you are, getting started in that because you can't own a life insurance policy until you're 18. So Stephen's still fairly early in the process. We all are technically, but you're the youngest and the newest on the scene, so to speak.
So at this point, I own 4 life insurance policies. One of those is a convertible term policy. It gives me the death benefit I want, and I can convert it to whole life insurance anywhere in my life.
And the other 3, I assume, would be whole life.
Yeah, the other 3 are whole life. I went
dividend paying whole life insurance.
Yep.
Okay.
And it's a 30-year term policy.
Oh, okay. So you have several years on that. You're roughly 20. You're 22, so you've got.
I'll be 48 because I bought it when I was 18.
Oh, okay.
So
all right.
Once I'm 48, that policy will expire. But I was so young, the rates are so cheap for it, and I can convert it to whole life anytime in that period.
And, God forbid something happens health-wise or ability-wise and he's not able to buy insurance, then he has that death benefit. He can keep it. They're not going to take it away from him. As long as you pay the premiums, they'll keep it in force. John, you were the one with the most experience of all of us. Let's hear what you think about and how you manage your policies?
I have 6 different whole life insurance policies. 4 of those mom and dad had bought for me over the years and then gifted them to me after they borrowed out everything they had paid in premiums. And I have been able to fill some of those back up with my savings over the years. I also bought 2 whole life insurance policies on myself and a convertible term policy.
Okay.
And I use it as a place to store cash as well.
Very similar to Steven's.
Yes, and I borrowed from my policies to start a couple different businesses. And
Okay.
fund the opportunities that arise there.
It's wonderful. I love the fact too that just about anything you buy in life that's a consumable, you buy it and then you don't have that money for a while. If you're paying yourself back, it eventually comes back in, but you don't have the money. With a whole life insurance policy, not immediately, but at some point in time in the future, it's worth more than you paid for it. So
Pretty nice.
yeah,
I paid the premium on one of my policies just the other day. I was looking, I paid like $687 and the cash value grew by $823. That's a pretty good deal. Why wouldn't I keep doing that?
that's a great deal. So
That's a policy that mom and dad started for me when I was 20. So now that I've taken over that policy, it's several years old. It's running efficiently. I pay the premium. Cash value grows automatically like that.
So I'm curious, what do
incredible.
you have going policy-wise right now?
that's a good question. When you guys started saying how many policies you owned, I realized I should probably count because I don't actually know. I have a file hierarchy in my computer. It's in my folder of policies.
Okay.
And I have a folder dedicated to each policy, so I could count them relatively easy. I just don't know what that number is right
Sure.
now. I think it's somewhere between 6 and 8, like 6 to 8. At the most 8, at the least 6. I think is. Probably.
Let's call it 7.
Okay, and that's all whole life insurance policies. I've been thinking recently I should probably pick up some convertible term as well for the long term. I have a decent amount of death benefit, but I would like the certainty of being able to have more death benefit, as I get married, raise a family potentially. So I should probably pick up that convertible term.
I added my term insurance right before I turned 30 because I knew the rates would go up
Oh, sure.
there. So I already had a fairly substantial amount of whole life too. But I thought, if I'm getting married and starting a family sometime in the next decade, I'd really like to have more insurance coverage. And I know it's going to be less expensive if I can buy it.
Yeah, see, that's a good point.
Did you go 30-year term on that?
I went 30-year term as well.
I've been thinking that roughly
So
too.
I wasn't able to get a lot of term because I already had a pretty high amount of whole life cash.
Because you can't have more than
already.
your life value.
Yeah, so this is the thing
But
the
I
insurance
maxed
company
out what I
works
could
off
get.
of. Yeah. The insurance company works off of what they call human life value, which
That sounds horrible.
which sounds very mercenary, but you got to start somewhere. So this is what it is. They look at the health that you're in, your responsibilities, your earning capacity, how much income you make, and they say this life is worth insuring for X amount of dollars. So whatever that is, that's your
There's a
value,
factor,
and that's what they'll
there's a
insure.
factor. So I think it's between like 18 and 40. You can take 25 times your annual income, and that's the total
Yes.
amount of insurance. Then that multiple goes down. So I think when
It goes down?
It goes down. So if you're over 60, I think you can only take 10 times your income for the maximum
Yes.
insurance that you can get.
Okay, because it's 1840 for the first bracket.
Something like
Okay.
that.
Yes,
I
so
don't-
they
I
have
don't
it.
remember
They
the
have
exact-
it formulated,
exact
so you can
ages.
figure it out. But that's basically what human life value is figured off of, and then
And then there's other ways to calculate it. So you can calculate it based off a needs approach. You can look at what's the balance left on the mortgage and how that's going to be decreasing over the years. What are living expenses that you'd want to leave for your family? And then you can solve it backwards and say, if you were able to earn a 5% rate of return on a lump sum of money, how much money would you need today to cover all of those needs? And you can figure it that way too. So there's different ways to approach it. Different people do different things.
yeah.
And there is a science to it, but then it also comes that there's an art process to it too, because many people may carry more insurance than they actually need or less than they actually need if they feel like they could adjust lifestyle and other factors.
Sure. And I use my policies basically the same way you guys do. A place to keep money I'm saving and where it's available. If I want to use it for something, I'll take a loan and then I'll pay it back and it'll be there again. That's anything you buy in life, has a cost to it. But when you're paying premiums on a life insurance policy and it's worth more than what you've paid for it, it's not really like spending money. So what if you're paying, let's say you're paying a $50,000 a year premium? Do you really care if your available cash value goes up by $55,000, $60,000? If you decided, I'm tired of paying this $50,000 premium, you surrender the policy and you get more money than you have ever paid in premiums for all the years you've paid in premiums.
Still a good deal.
That's not
Might have been a better deal if you kept it.
Yeah.
Yeah. I'm working with some people right now doing some projections as they get into retirement, how they might use their policy values. It's really nice to have those policy values when they get to that stage in life. It gives them more options about where they get the money from. Something I think people would be interested in hearing is, how did we get started with the process? What did our parents do to make us interested and understand these policies before we took over the policies that they gave us, so that we understood the value of these tools?
Yeah, because what mom and dad did is they funded life insurance, whole life insurance policies on all of us. They get better with time. And so the fact they were able to start on us when we were teenagers, or in your case, maybe even younger than that, was wonderful, because now our policies are several years old and they're performing much better than if we had started them when we were 18. And then what they did is, since the policy cash value was higher than what they've ever paid in premium, they borrowed the cash value, and we were able to assume ownership of those policies, start paying premiums, and we had the outstanding loan from the cash value they'd taken.
We had some big outstanding loan balances when they gave those policies to us, but why didn't that concern us?
Well, for one, we have a great performing policy.
Yes.
So we could start paying back those policy cash value loans over time if we chose. Or in some cases, if we had the savings available, you can just put your savings right into that cash value.
Great place to keep it.
Interest will stop, and you have a great place to keep money. So, however, we took those over, and I would imagine we had a different way of doing it for all 8 of us. Whoever took their policies over, whatever situation they were, they probably handled that interesting or differently. But it was incredible. It gives you a jump start in the process that you wouldn't have had if your parents hadn't looked out for you. But I think what you're asking, and very important, how were we able to assume the ownership of those policies and continue paying premiums and understand the financial benefit they were and how to manage them without losing all the years that our parents had started for us?
A lot of 18, 20-year-olds would have just dropped them.
Cash
not
out.
paid the premium.
Bill and taken the money and done something else with it. The short term.
Yeah.
We would have lost a lot of long-term benefits if we had done that. I think the key there is they involved us in what was happening, what they were preparing for us, and in what they were doing.
That's what I was going to say.
Before we got to that point, we understood the value of it by the time we got to 18.
And I didn't really see it any different until I got older and noticed how other families do it. Because we just always did it the way our family did it.
There wasn't really a choice whether you did infinite banking or not. When I was growing up, it was just like, you eat, you sleep, you do infinite banking. It was just a way of life. So of course,
What a beautiful way, though.
Yeah, it was just like, of course I'm going to pay policy premiums.
Yeah. So now that I'm older and I see that not all families function like that, I'm incredibly grateful ours did. But and at the same time, I never knew I had a choice. Yeah. So and mom and dad encouraged an environment where we just worked with them. We did everything with them. So, I mean, we were very much aware of what was happening in mom and dad's finances as we were growing up, what they were doing, why they were doing it, what changes we were, what groceries we were buying, what we were going to be eating, why we were eating what we were eating, why we were spending what we were spending, where we were spending, all that stuff.
I remember going to the store with mom and we're like, well, which is the better price per ounce? And why don't we get this even though it's less expensive? Well, this is better quality. And
Or and we would
can we
work
buy
around
this
the house.
this week? No,
we would work
not
around the
this
house
week
doing
because
things just to help with the, because those were things we needed to do as a family. We didn't get paid an allowance for doing those things.
Yeah.
So it didn't give us an entitlement mindset. I think that was important.
Sure. And I don't remember mom and dad acting like they had solved every problem and it was a formula you just follow. They would involve us in their reasoning and their thinking along the way. And I think that's probably the most important thing is to be able to think through a situation.
Yes,
You boys
you're
are
always
probably-
going to encounter special situations.
You boys are probably going to smile about this one. In fact,
I know what you're going to say.
I know where you're headed.
Oh, I did.
So we were home educated, and the program that we used for our math is called Saxon.
Oh, yes,
Math.
I do
It's
now.
It's an excellent program. We would start the 5-4 book. Is math? It was called Math 5-4. It's the very first one,
Well, maybe I don't.
and we'd start that when we were, I want to say maybe 4 years old.
Yeah.
So it started.
We started pretty young.
with addition facts. So that book we started about age of 4, I think it was. And then you would go through 6-5, Math 7-6, Math 8-7, Algebra Half, Algebra 1, Algebra 2, Advanced Mathematics, and finish with Calculus about the time you were 16, 17. And so it was time, you had to do a lesson a day at least. And some of the easier books would be 2 lessons.
When I started, I remember my first day in 5-4,
Uh-huh.
and we only went to 8.
Oh,
But
problem 8.
we
There were
worked
like
out,
25 problems,
Yeah.
25 to 30
25
problems
to
in a
30.
lesson. And we did a math lesson a day, sometimes 2 in some of the easier books.
You get used to solving problems.
And yes, you have a problem, you get used to solving it. Well, anyway, we could also call Mama for help if we had a question. So we'd be doing our math and we have a question, we'd need Mama's help. And Mama would come to help us. And what I appreciate is that she'd never just give us the answer and then tell us how she got it. She would ask questions to help us get through to the answer. And sometimes that was terribly frustrating because, your kid.
Oftentimes it was terribly frustrating.
All right, point taken. Point taken. It was a kid doing math who really wants to finish their work so that they can do other things. At that point in life, you just want to know the answer so you can put it down and get out of there. But Mom would ask questions to help us arrive at the answer. And one of the most frustrating things that she would say, but tended to work, was think of a problem you already know. For example,
Think of anything.
yeah. For example, if you have the problem, I'm going to use something really simple. 5 take away n equals 3. And you say, well, what is n? That's the question. 5 take away what equals 3? The answer is obviously 2. That's easy, right?
Yes.
So we we come upon a problem, let's say it's a little more advanced. Let's say 66 take away 7. Oh, sorry. I should say 66 take away n equals 7. Well, how do you know what n is in this problem? It's not immediately obvious like it would be with 5 take away n equals 3. So Mom would say, you need help with 66 take away n equals 7. Well, think of a problem you already know.
I can't think of anything.
Okay. Well, think of a problem. You're supposed to say 5 take away n equals.
Okay.
And she would say, well, how do you know what n is?
Well, that's obvious because it has to be 2.
Yes. Well, that wasn't what she was after.
What if you didn't know?
What she was after is how do you make 5 and 3 tell you 2? Because you know n needs to be 2. So how can you arrange 5 and 3 to make it say 2?
We'll use take away 3 from 5.
And that's the answer to the more complex problem. You go 66 take away 7, and it'll tell you exactly what n needs to be. N needs to be 59. It's very simple. So with
They
that
taught
kind
us
of
how to
thinking, it transfers over to other areas of your life, and that's what we do now. You don't know the answer to a situation? Think of a situation you've already been in. What was the right answer for that? And does that give you any clues or help you make the right decision in your current situation? And a lot of times it will.
Most of life is just problem solving, and the more effective you can problem solve, the better off you'll be in life.
That's it. I remember we had done a tour at the Wall Builders Museum in Texas, which is one of the largest collections of Founding Fathers documents. It's really incredible. I remember one of the guys in the tour at the end, he told Dave Barton, he said, I was never taught how to think. How do you think? He was very
Here's
perturbed.
this older guy, very distraught about this.
Yeah.
Yeah, it was
That
sad.
would be
So
very
I didn't
rough.
realize, at that point, I don't think I had realized to the extent I do now how useful it was to learn how to think. You can know the answer to, you can memorize the answer to all kinds of problems. If you know how to think, you can find the answer to all kinds of problems.
We use the ability to think in many different situations in McPhee Insurance because every client's situation is different, but they have certain similarities that we can think of things that we already know and figure out solutions, better solutions for our clients that they'll be able to use for many years to come.
That's how we write good infinite banking policies for anybody who needs them.
The numbers change from client to client. The strategy can sometimes even change from client to client, but the principles remain the same. And by thinking creatively, we can apply those in the most effective way. There's a lot of things to know to get the best policy for the infinite banking concept, but there are also a lot of things you don't need to know. And if you stop to analyze them, it can delay you from getting started.
When I was growing up, we had this little book on Davy Crockett, and something I remember from that story was he had a motto, and his motto was, make sure you're right, and then go ahead. That is some of the best advice when it comes to the infinite banking concept. Make sure you're right, and then go ahead. But don't go ahead if you aren't sure you're right, because getting a good life insurance policy is critical to implementing the infinite banking concept.
If you are a client of McPhee Insurance already, you have a good policy. We know that. If you're looking to get started with the infinite banking concept and you want a good policy, we can write good policies. Make sure you contact us for that. And if you're already doing infinite banking and you have a policy with somebody else, but you don't know for sure, beyond a shadow of a doubt, that it is a good policy, make sure you contact us and get that policy review you heard about earlier. It is so worth the financial peace of mind to get that review. Friends and fans of the Wealth Talks podcast, it has been so much fun crashing the studio while Mom and Dad are gone. They are scheduled to be back from Florida next week, so you will once again have your familiar faces and voices
Right here
on Wealth Talks.
I wonder what they're going to talk about.